Welcome, everyone, to my talk. I'm really happy to be here. I had the opportunity to be a part of this community too often. I spend a lot of my time in the Ethereum space, but recently we've been branching out into Cosmos and other chains beyond. So I'm going to tell you a little bit about kind of our ethos around what we're doing here at last. It's all around sustainable yields and sustainable incentives. Give you a little bit about me, who I am. I'm the co-founder, CEO, and CTO. I have been working in the space since 2016, full time. I've gone through a number of different initiatives. Previously having a company called Block Pressure Labs. We were a venture development studio. We prototyped ideas and then built and raised capital and teams around them. The two accelerators in 2018, I do not recommend it. It's definitely enough. And for the last couple of years prior to Seven Labs, I was the head of engineering at Stereo. So it's a DeFi protocol building in the NFT lending space. So, one of the biggest takeaways we've realized over the last couple of years is that the core product market fit of crypto, above anything else, is actually yield. It's pretty crazy. We talk about trying to build these new distributed systems, but ultimately at the end of the day, speculation has taken a hold of most of our industry. If you look at what's coming out these days, a lot of it is financial in nature. But if you want to talk about, how big the space actually is, what are we talking about in terms of raw numbers? It's about $97 billion currently available yield-bearing assets today. That's across a number of different avenues, part of full swing of it being. It's pretty crazy when you think about it, given that, I think, USDT, it's a stablecoin, is right around there as well. Stablecoins are also one of the other things about product market fit. But what are we all about here at last is actually trying to provide an environment that is very builder-focused and builder-centric. And it's all around this concept of sustainable yield. So for those of you who don't know, yield is really just like an factoral market when there's inefficiencies in the actual market or it's utility-driven speculation. But if you want sustainable yield, it's really hard to get. So yield by design, the trend is zero. As people in the market decide that they want to earn on top of their assets, they tend to enter into a market, and that overall interest that comes from those assets trends down pretty aggressively. You see it with, the relative risk-free rate from staking, other Cosmos validators or Ethereum validators. We saw it recently with the launch of the Athena bond. It came out very high, like 62, 63%. It was right around inefficiency for the basis carry trade. It is trending down pretty aggressively, down to around 10% right now. We're on the same as lending, even with stable coins. It has to be responsive to market demands. What I mean by this is that, going to the previous point, is that if you are looking to capture and generate sustainable revenue from yield, you need to be done in a way where you can actually adjust and be responsive to what's happening. So if there's new assets coming out, new sources of revenue, new chains, whatever it may be, and you want to partake in those ecosystems, you need to have designed in a way to partake in those. Sustainable yield should be risk adjusted and weighted. You can't go too heavily into any one asset class that yields tend to zero. You'll be left basically with a low return on your value, probably even less than the U.S. Treasury rate, which unfortunately though is considered to be the global standard for risk-free value. And you need a holistic market exposure. And what I mean there is something that is actually capturing multiple sectors, so real-world assets, on-chain, lending markets, perps markets, whatever it may be, anywhere that there's interest being paid out on a loan or anything of that caliber. That's how you achieve it. So at Last Network, we call ourselves the shared incentive layer for everything. And so what I mean by that is quite literally, we are a new ecosystem design whose whole purpose is to incentivize deep, robust liquidity on any chain, any protocol. So our goal is actually to incentivize you to use your favorite protocol that generates yield and actually bring us that effect. Our whole goal here at Last is that we want to make sure that we are this symbiotic layer that helps ecosystems maintain robust liquidity markets. We've come to learn over the last few years that without robust liquidity for your DeFi protocols, you actually have a chain that generates very little revenue and offers very little utility for users, which tends to actually kill the consumer market, which is actually a knock-on effect for DeFi or liquidity. So since we're complementary to other chains, what we actually want you to do is to go and invest in these protocols on any chain. It could be the upcoming Bear chain, it could be a Blast Ethereum L2, it could be Ethereum itself, compound elevate any protocol, Bitcoin natively, it could be Cosmos, Osmosis liquidity, whatever it may be. We want you to go out there and actually put your capital to work. Now the advantage we have is that we can actually drive sustainable incentives for everyone. So this is builders. You can do transaction fee revenue sharing, access to Gage's trader protocol, which is our incentive engine. We want to pay our governors of our ecosystem, those that actually help us decide and move forward. We don't believe anyone should work for free. Those liquidity providers, potentially yourselves, who are using these protocols and putting your capital to work. We want to make sure you're earning additional yield for the risk that you're taking and the value that you're providing to us. And our node operators, we want to make sure that your block rewards are high, the transaction fee revenue sharing from the execution environment is going to you, and we also make sure that you have access to additional revenues through a concept called base seeding. So what do we mean by sustainable incentives, though? Like, how is it possible, and how can we actually achieve this? So in our case, Lance is a unique system design. We actually technically have two chains. We have what we call the utility chain and the application chain. So the utility chain is a completely new network that's fun, but it doesn't work in a similar way that you would expect from a standard Cosmos chain. It actually is designed entirely as a bridge and accounting system. So it works much more similar to what you experience for centralized exchange hot wallet system or depository account system. We're actually able to abstract and witness transactions across any network. And we allow you to do restaking and accounting of your yield-bearing assets on any of these connected networks. This is advantageous for you. So if you're providing liquidity to the compound or to the lending market on Solana or Sweet Aptos, Cosmos ecosystem, whatever it may be, you can actually get instant access to your principal and your yield in real time on top of the last network. Ultimately, all of our validators, since they do all this attestation, you get like access. All that yield, as well as really fast finalization of your enrichment. Our app layer is a little different than your standard Cosmos affair as well. We actually are running an EAM on top of our base chain. We believe in this concept of modular system design. So we love the fact that we could swap out our EVM for a different virtual machine if we need it in the future. There's a lot of work being done right now around parallel execution for the EVM. If you're familiar with how SAY's design system is, they have a really nice parallel EVM. It's currently being migrated to the newest version of Cosmos as well, which we've allowed to play into our ecosystem since we are a common BFT chain. Modular systems designs allows us to replace things like DA systems, gives us really low fees, fast transactions, and really high capacity, since we are settling nearly to the utility chain itself. Our whole system design is about escrow governance. And what this allows for us to do is democratizing the flow of assets through our system and allowing you, the user or the governor, to partake in our precise rewards for doing so. What this also enables is for protocols building on top of Blast can actually get access to the Gage marketplace itself, and then they can take and incentivize users for liquidity into their protocols. So since our whole system design is around reauthenticating liquidity from other networks, you as a builder all of a sudden will have access to a wide variety, highly diverse asset base for collateral types into your emerging protocols, for DeFi systems, or for consumer applications that we need them. And the biggest thing is that our app layer and our mission structure is actually not done with your standard, just like a naked token emission. You're actually bringing an option, and that option is a discount to buy a vote for cheaper than the market has to sell. So this allows you to lower your cost basis for the rewards you're actually captured by the marketplace. And you can earn additional incentives and votes using every stake yield. So our whole thesis at last is actually to reinvest all revenue that the chain generates back into the ecosystem's growth. We don't believe in being an extractive entity who sits there, captures value, and does nothing for you, the user. So Lance is actually run by a mission-driven foundation whose mission is to make no money at the end of the year, to spend to develop all that out into growth, to powering this ecosystem, long-tail sustainability. We do grow an on-chain endowment fund that we use the yield from, so it's very similar to the Stanford yield model around actually providing for long tail incentives. And we truly believe we can actually incentivize everything. So it's from liquidity coming to the network, driving user behavior, both on chain and off chain actions that can pay back users, help builders get to the where they need to be sooner and faster. So that's me. I'm Andrew Lloyd, and this is Last. Any questions?
Yeah, right. Please. Yes.
In the back?
Sir.
Can you elaborate a little bit about the yield option information?
Yeah. Sure. Our options mining system. So if you're familiar with curve finance or any other vote escrow gauge systems, generally speaking, it's very much like inflation. So there's a emission that comes out in the form of the actual vote asset itself. We don't believe in a free lunch. Anyone that wants to partake and be exposed to the network, specifically for bribing, bribe revenue is a huge source of funds for you. And so what you actually earn every week is an American style call option that has a fixed discount rate. So every week there is a snapshot of the market price of the actual voting token or last. And then depending on the asset that you've actually staked into the network, you get your variable discount rate that is set. So if you brought, staked Bitcoin by Babylon or staked ETH, could be liquidity in the compound, could be liquidity in osmosis. Any of these on the gauges have a multiplier of the discount. So every asset gets the same base discount rate, but maybe the one that you brought has a 10, 15x multiplier on that. So the idea here is that you pay a little bit of money, you get an asset at a much steep discount, but you're locking it into the vote escrow system for a period of time. The longer you lock, the more that actual modifier discount you capture. So the idea here is to find alignment with our users. You get a cost basis that's lower, but you're long-term invested in the ecosystem. Every week you get a vote in the actual bribe marketplace, and the chain itself funds some of those bribes. So you don't have to recoup your costs from the option to execution over time. And we think this is a really healthy way to go about it so that you, as an actual active participant, are aligned with the network, just generating revenue for everyone, and also able to recoup the benefit or the cost that you're spending to actually get into the network.